All right. So, hello everyone. Welcome to the Prudent Finance Great Conversations podcast. Today, we are honored to host Dr. Timothy Ed Savage, a name synonymous with the cutting edge real estate economics, data science, and institutional strategy. Tim is a clinical assistant professor at NYU Shack Institute of Real Estate, where he also leads as the faculty director of the CREFC Center for Real Estate Finance. Prior to that, he served as the senior managing economist and the principal data scientist at CBRE Economic Advisors, formerly the iconic Torto Wheaton Research Group, a pillar in commercial real estate analytics. With nearly 25 years of consulting experience at firms like Charles Rivers Associates and Navigant, Tim brings a rare combination of academic rigor, real world expertise, and a deep understanding of how machine learning, Bayesian analysis, and Monte Carlo simulation are transforming how we evaluate business strategy. He has advised institutional investors, shaped conversations on macroeconomics and policies, and have been featured in various major platforms like Wall Street Journal, NPR, the New York Times, Axios, and the Urban Land magazine. A former distinguished fellow at the NAIOP Research Foundation, Tim also mentors emerging voices through the Real Estate Research Institute and currently serves as the chief economic advisor to the 45 Park, which is pioneering innovation in the single family rental as well as the build to rent markets. And beyond all that, Tim's is an avid cyclist, a swimmer, and a tennis player as well, bringing the same energy into his life as he does into the research and teaching. In today's episode, we are going to dive deep into some of the most pressing questions in real estate and economics that are: how is machine learning reshaping CRE values and the strategy? What role does Bayesian thinking play in uncertain markets? How should investors read macroeconomic signals today? Why are single family rentals becoming an institutional favorite? And how can cities use big data not just to build, but to build better? So whether you are an investor, policymaker, student, or just a curious mind navigating the intersection of real estate, data, and disruption, this is a conversation you don't want to miss. So let's dive into the Prudent Finance Great Conversations podcast. Hello, Tim. How are you? It's an honor to host you here. And how are you feeling?
I'm very well. I'm very pleased to be here. And looking forward to the discussion.
Yes. To be honest, when I was first researching for different people to hosting for my podcast, I was finding an expert in real estate markets, and also having a merge between the knowledge of how real estate markets are shaping, because decades are passing by, the markets are becoming dynamic, and so on. So I would start with the first question. We will go back in time and let's track back some of your previous life, not previous life, sorry, some of your life. We will track back some of your, you can say, career life. And we will also track back how you came into this real estate domain and what enlightened you about it. You can talk about your PhD as well, and as well as about how you became a professor at NYU Shack and so on.
So for me personally, we go back essentially to May 1999, when I defended my dissertation, which was entitled "The Long-Term Effects of Youth Unemployment." And this was a very novel dissertation in that prior to it, the belief was that essentially there could be a permanent scarring effect if young people experienced unemployment. A scarring effect in the sense that their wages might be depressed for a lifetime, based on experiencing a spell of unemployment. And in my dissertation, I developed an elaborate economic model that essentially allowed for the possibility of a catch-up. That if a young person experienced a spell of unemployment, they might have the ability to get more education or more training. And that through that effort, expanding their human capital, if you were, they could essentially catch up. And the dissertation basically shows that using a very sophisticated algorithm. And that's when it was during that time period, and my wonderful dissertation advisor, Dr. Thomas Mraz, really taught me the power of combining data analytics, or we in economics just call econometrics, with the economic models to explore how the world works. And that fundamentally is what I try to do whenever I undertake an exercise. I'm just trying to figure out how the world works, using data and models, combining them together with analytics to answer important questions. And so I then went into consulting rather than into academia, which Tom was not happy with at the time. But later we would publish a couple papers in The Economist. We would publish my dissertation, and he essentially started speaking to me again.
Nice.
But I went into consulting, and I went to Charles River Associates in Washington, D.C., focused largely on merger and acquisition activity. So CRA, as we call it internally, was a very well-known consulting firm that would typically represent merging parties in front of the U.S. government, the FTC, the DOJ, and we would present, again, evidence to suggest that the merger wouldn't lead to higher prices post-merger because
yes,
the merged entity didn't have market power. And again, you have to do that using data. You can't just hypothesize about that. So while I was there, we started to use some fairly sophisticated economic models to examine this question. The challenge was that, how to put this in common parlance, we needed to know the variance, right?
Okay.
So we're predicting a price effect. We need to know the variance. These were very sophisticated economic models, and that was not at all easy. So when I was there, I introduced the idea of essentially what we call bootstrapping. That is, you just replicate many times.
Yes,
and that's when I became very interested in simulation. And I worked on a lot of interesting mergers there and at Navigant. And I had done well enough that I sort of put the consulting career on part-time and began to get engaged with NYU. And
that's nice.
And so I started to teach as an adjunct in the Tandon School of Engineering at something called the Center for Urban Science and Progress. And again, there I did, I taught all of these ideas to students. And I enjoyed that a great deal. And then an opportunity arose, basically, a headhunter contacted me out of the blue and said, well, what do you know about real estate? And I said, well, I live in New York. We live and breathe real estate all the time.
The most enterprising real estate market.
you can't go to a cocktail party and not talk about real estate. So to that extent, I know a fair amount, and I'm willing to learn. And he said, well, they're looking for a senior leader to move to Boston to essentially take over what was the famous Torrey Wheaton Research Group, which by that time had become part of CBRE entirely and had been rebranded. And so I thought, oh, this sounds like it could be interesting. And so I trained up to Boston, gave a talk. Ray Tordo by that time had retired, but Bill was at the talk. And the talk was entitled Economist and Machine Learning. And the point I made because by that time, the phrase econometrics had fallen out of favor, even within the economics discipline, with the new phrase machine learning becoming popular parlance. And I actually prefer the phrase machine learning to econometrics. I think it's much more descriptive what's going on. And so I gave this talk. They made me the job offer. So I moved to Boston and took over this group and worked closely with Bill to help to restructure it, because that's really why they brought me there, was to help to restructure the group. And that's what Bill and I worked on closely. And then I said, hey, Bill, why don't we think about doing some other types of work together? So we would write client reports, and we would talk about new and innovative things in commercial real estate. In particular, at that time, WeWork was becoming very popular in the United States. And so while we could not use the phrase WeWork because they were a CB client, Bill and I sat down and we wrote out a relatively simple but descriptive model about how co-working or agile workspace could actually work in the real world. And senior leadership loved it because it gave them a better understanding of the challenges of co-working. And at the end of it, we did a little piece of machine learning trying to determine whether value of space would be impaired if the share of space that was co-working rose. And we found essentially that you can get to about a third of the space as co-working without impairing values. But once you get up above that 30% threshold, values do become impaired. And the reason we argued is at that point, your tenant quality is declining. You're bringing in prop tech startups and folks like that who have a high probability of failure, and you're not getting in the 50-year-old accounting firm. So leadership loved it. It was great fun to work with Bill on that. And Bill and I worked on a couple other things together like that. I encouraged him to write on our newly created blog site because he's a brilliant writer. And he wrote some really good stuff, especially on inflation, which again, at the time was somewhat of an issue as it is today. And the question is, does the value of a property, what is the sensitivity of the value of a property to inflation? And we showed essentially that certain types of real estate, like retail, is not at all sensitive to inflation because typically retail just passes that inflation on to consumers, and so they don't have to absorb it. But office is sensitive to office valuations are sensitive to inflation. That again is relevant today because of the tariff situation, because tariffs are a form of inflation. So Bill's completely retired now, but I have some other connections in the industry and in academia where I think I would like to try to redo that work, thinking about tariffs as the alternative to inflation, or as essentially tariffs as a form of inflation, and talk about the sensitivity of properties. The travel schedule was brutal. I enjoyed the work a great deal, but the travel schedule was brutal.
I can understand.
It was so strange because I was living in Boston, spending almost half of my time in New York. And I finally said to leadership, why can't I just move back to New York? I'll come up to Boston a couple days a week, but it's easier for me to live in New York. And especially when I'm doing client meetings, most of CBRE's econometric advisors' clients were in New York, right? It was the large asset managers, all of whom were here. They didn't really agree with that. So I began to consider alternatives, and an opportunity to join NYU Shack full-time arose. And Shack has a storied history. Founded in 1967 by Larry Silverstein himself.
That's good.
Shack is located. Yeah, Shack is located at the corner of Fifth. Well, one building in, but essentially is at Fifth and 42nd. And the reason Shack is there rather than in down around Washington Square Park, which is where most of NYU is located, is because Larry. Yeah, so Larry owned the building, and he had a spare floor, and he created something called the Real Estate Institute.
That's nice.
and was very influential in helping to shape, at that time, the curriculum by saying that this is what it was, purely a night school, because the students worked during the day and would take classes at night, and they were proximate, again, large concentration of institutional investors in that area.
Yes. Yep.
Especially along Park Avenue, right? So it's within walking distance.
Yes.
So I joined, and my mission was basically to take everything that I had learned from CBRE and develop a curriculum around it. So I revamped both the economics and finance classes that we teach, and then I created what we call applied analytics, but it's really basically machine learning for commercial real estate. And that's what I've been doing for the last 6 years. And then for a while, I wasn't doing much public speaking because I was focused on getting that right. And now that it's working fairly well, I do much more public speaking now, basically to talk to institutional investors about what they should be thinking when they look at the changing terrain of real estate. Because at least until the prop tech startup world appeared to be changing things, large owner-occupiers thought they could ignore all of this stuff. And when I would talk to them institutionally, I would say, do you charge more for the 10th floor in your building than you do for the 5th floor? Oh, of course. And I would say, well, why is that? And how can you quantify that? And I've done a couple of consulting engagements where I said, okay, just give me the building floor plate. Tell me who the tenants are. I'll match them to something like Dun & Bradstreet data that identify, but anonymize the actual tenants. And we did studies. And I basically said, yep, you should be charging, say, 10% more if you're moving from the 5th floor to the 10th floor. And so those were all very fun engagements, but it's always been the idea of taking an economic concept, taking data, and combining the two using an algorithm or more than one algorithm. And it's been both an intellectually rewarding life. It's been a financially rewarding life. So it's and it keeps me in New York and B, in real estate. So that's why I enjoy doing this stuff.
Yeah. No, it actually shows me that how dynamic a person's life can be in real estate, especially when you are working towards different economic versus machine learning models and trying to build stuff each and every, you can say, aspect or each and every year of your life, to be honest, and then working on different, you can say, career trajectories, where sometimes you're a professor, then the consulting comes into play, then you become the head and so on. So it's kind of nice to see that how you propel between all of those, you can say, domains and worked around your life till now.
And from the Bayesian perspective, so I was trained at a time where Bayesian analysis was understood, but we didn't have the computational tools to really use it. So we learned it in class, and then at the end of that lecture, the the statement was made, but we don't have the computational power to do this. So along comes computational power, which means we can now simulate rather than estimate. And that opens up the world to a Bayesian reinterpretation of everything that I've done in my career. And so I've become, so sometimes Bayesians are called cultists, but once you get involved in it and you realize the mathematical elegance of it, and that in fact, we've been using it in one shape or another for more than 100 years. It's helped us to do many, many things that conventional statistics don't allow us to do. And so I actually, when I teach my analytics class, we start with conventional tools, conventional machine learning, and then through the arc of the class, we ultimately get to the Bayesian reinterpretation of everything that I've taught them. Because I basically make the point, for every algorithm I've taught you, there's a Bayesian reinterpretation of it. And let me explain to you why the Bayesian reinterpretation is more powerful. And we've just come to understand so much more about the world using a Bayesian approach, which is really just probabilistic, right? It simply says, we don't know what's going to happen tomorrow. Okay. We don't know what is going to happen tomorrow. We can only speak about it in terms of probabilities. And that's exactly what Bayesianism is. It's just basically saying we live in a probabilistic world because the future is uncertain. And it becomes really powerful there. So, and that's sort of what I have brought to 45 Park, this new emerging market of single family rental and build to rent in the United States. I don't know whether we've exported it elsewhere, but in the United States, as you know, we have an affordability crisis. We aren't building enough houses. Yep. So a statistic I like to cite is the fact that we're building in the United States, we are building no more housing today than we built in 1960, but the population has essentially doubled. And that's the affordability crisis. We simply aren't building enough space. So my hope in working with 45 Park is to begin to attract institutional capital to the single family rental and build to rent markets, so that essentially it follows the development of sophisticated multifamily in New York, or in the United States, in places like New York. And that's what we're focused on. And we had an all hands call last week, and we're doing well. We're getting,
that's nice to know,
clients. Yeah. We're getting clients who are paying us to use the technology that we've developed to help inform their decision making. And again, when they ask me to talk to clients, I don't use the phrase Bayesian because I can be off-putting. I just say it's probabilistic. We don't know what's going to happen tomorrow, and what we want to do is to build in that uncertainty, and that's really important, because one thing I learned when I was at CBRE is the sensitivity of results to new data. So in the commercial world, in the United States, the data are typically quarterly and time series that don't go back more than about 40 years. So there's not a lot of data.
Yes, correct.
So when you tack on another quarter of data, you can change the results of conventional statistical results. That's not true with Bayesianism. Bayesianism is not overly sensitive to an additional data point. And in fact, you can model that probabilistically. So all of this has kind of come together at 45 Park. So I advise them on financial modeling, on statistical modeling. I talk with their clients. We now have a partnership with the National Association of Realtors in this country, which will give us access to a very large group of residential sales brokers. And we want them to use our platform, to use our ideas when they think about pricing a house. It's the same question. How would you value space? And so we're ingesting large amounts of data, both traditional real estate data through the multiple listing service, but we augment that with other types of data, data on foot traffic, data on school quality, data on crime. So we can develop very sophisticated models, and they sort of the models hide behind this technology platform that the technologists at 45 Park helped to develop, or did develop. And so everything's coming together nicely. And so I under NYU rules, I'm not allowed to spend more than 1 day in 7 in outside consulting. So I've dropped all my other outside consulting, and I spend about a half a day a week at 45 Park, which is in a very old building down near the iconic Flatiron building.
Yeah. No, it's I'll be happy to visit that building as well someday. But on that Bayesian thoughtful process which you told about, we often see that people are more towards into the economic trends which are traditional in nature as present. Yep. And I have a question related to you as well, that according to the Bayesian model and you can say Monte Carlo model itself. So basically, what is the transition from the traditional economics in the real estate market, which you see, and how the Bayesian model outperforms that traditional, you can say, economics models or econometrics, which is today the most important in CRE?
So it's something that's really quite interesting called a Bayes factor, or Bayes factors. And Bayes factors essentially allow us to determine what is driving value. So if we have a statistical model that has both the traditional real estate information as well as things like crime or quality of school, we can basically use these Bayes factors to determine which one of those variables is the biggest driver of value, and it varies by geography. School quality is very important in and our focus is mostly on what are called the smile states in the United States. So basically southeast, kind of Arizona through Texas, up through North Carolina, and then down through Florida. Okay. Because that's where the ability to construct is much easier there due to reduced regulation. And important drivers in a place like Buckhead, which is north of Atlanta, are different than important drivers in Tampa, Florida. And so we are able to tell clients, as they're putting together an investment thesis, where they might want to locate. So this is basically becoming a tool to help do site location. And that's mostly for single family rental. Build to rent's fascinating because you have to price dirt because there's nothing there. And so we're able to essentially mirror the single family rental approach to the build to rent. And we can say to a developer and a large institutional investor who wants to develop, here's where you need to locate. Here's the rent you're probably going to make. And here is a probabilistic forecast of the rent distribution, because that's what's important for those institutional investors. What sorts of monthly rents are they going to get for the space that they build? And then they have the one challenge in single family rental is that there's a lot of differences in the properties themselves. Build to rent, the way to think about build to rent is to take a big apartment complex and just put it on its side.
Okay.
And that allows for institutional investors to say, okay, well, we're going to put in the same refrigerator everywhere, the same washing machine everywhere, the same dishwasher everywhere. We'll keep some of the units, and we'll have essentially overflow or storage of units. So if a refrigerator goes bad, you're able immediately to replace it with the same refrigerator because you have one of those.
Correct.
Right. For example, in my apartment, 2 or 3 weeks ago, when the weather started to get warm, and I turned on the air conditioning in my living room, it was not engaging. And I thought, oh, well, the compressor's gone out. I emailed the building. There's somebody here in 20 minutes. He looks at it and said, yep, you're right. The compressor's gone or is burned out. I'll be back in 20 minutes with a new unit. And within 20 minutes, he's bringing in the new unit. He pulls out the old unit, which took him a minute. He put it in the new unit, which took him about 3 minutes. He turned it on and it works perfectly. And that's the power or the potential cost savings in the build to rent market here in the United States. And as I say, I do have a public policy interest in this, in that I don't know of any way to solve the affordability crisis in the United States other than building more housing. We have to. And there's no obvious movement in Washington, D.C., in terms of policy that's going to do that. So my public policy hope is to begin to attract institutional capital so that we can break through the log jam and get more housing units built in this country.
Yes. And then talking about the housing, affordability as well. So I wanted to ask you, from like the 2008 financial crisis as well, we've been through and you have seen it throughout that time as well, and the 2000 internet crashes as well. So I just wanted to, and then the pandemic, and then the rise and boom of hiring processes, everything getting inflated and so on. First of all, I wanted to ask, are there any inflection points in all of these situations which you face in real estate markets? And do you believe that for the affordability, does factors like monetary policy, fiscal policy, and also the location of the area and everything plays a big role? And that's where the Monte Carlo simulation comes into play, because it actually builds a lot of, you can say, simulations or a lot of scenarios, and it will give the client or any institutional client who wants to invest at present, gives the situation, whether it's the best case scenario, worst case scenario, and so on. So how do you guys do it in real estate market at present?
Yeah. So let's take single family rental, because that's a more established market. What we have, as I say, traditional multiple listing service data. So we know essentially, in a repeat sales sense, the value of the property over time.
Yes.
And then we include in that local factors, crime rates, school quality, proximity to a park. And that's again where the simulation modeling helps a great deal, because through the use of these base factors. So we can say to institutional investor A, who wants to go into Nashville, where to locate, how much to acquire the property for, and then the distribution of monthly rentals that our model predicts. And that's where the Monte Carlo simulation comes in, because that you can't do Bayesian analysis without Monte Carlo simulation. They're just intimately related. That was a big breakthrough in using Bayesian analysis. It allowed us to expand the ways we did things by essentially marrying Monte Carlo analysis and Bayesian thinking. So when an institutional investor is looking to acquire properties, they obviously have to buy them, and they have to figure out what the monthly rent is going to be, and then because the future is uncertain, they have to think about this probabilistically, because there may be scenarios under which rent growth is low. And yes, all of this is influenced by, especially monetary policy. House values are sensitive to monetary policy. So we've seen over the last 2 years
for buyers and sellers both, or like,
so we've seen the strongest tightening of monetary policy over the last 2 years.
Yes.
That has not occurred in more than 40 years.
Okay.
So we can reach back with time series and try to evaluate those impacts. The other thing that house values are so the U.S. Federal Reserve has sort of two tools. It has interest rate policy, and then it has its balance sheet, which is very large.
Yes.
Though declining. And house values are sensitive to both of those. So again, we using public data, Fed funds for interest rates, the Fed's balance sheet, as that measure, we can include that in the models and demonstrate again that in some areas, developing markets in particular are sensitive to this. Secondary markets like Austin, very sensitive to it. And so if you're doing single family rental in Austin, you want to think about monetary policy, and you know, I don't know where it's going, but we can talk about it probabilistically, right? And house prices are sensitive to monetary policy as well as local market condition.
And it's according to you, like it's better to have like lower federal interest rates for a good affordability, or it's kind of like we can say kind of counterintuitive, because once the rates come down, the inflation might go up as well. So like, how do you see that the gap between, and does it does it affect location by location? So instance, I have seen that Florida is more prone to like storms and so and stuff. And so the insurance rates go high, whereas a house in Manhattan would cost much higher than what's there. So like, how do you see that in your Bayesian modeling as well as the Monte Carlo things? And how do you make your perspective on this?
Yeah. So again, this is where economic theory comes in to help. Yeah. So the Bayesian approach is somewhat agnostic. This is where again you go back to the first, say, 10 minutes. This is where you marry economic theory and finance theory, correct, with empirical, with data and algorithms to examine conjectures about how the world works. And the number of conjectures or the types of conjectures that you can examine with the Bayesian approach is much greater than with traditional statistics. We can begin to ask questions using a Bayesian framework that you could not using a conventional framework. And so again, that's what makes what we're doing at 45 Park so relevant, because we really are on the cutting edge of this stuff. We're securing patents. We're getting both clients and investors. So as a startup, we think we have a fair amount of runway. And at some point we'll stop calling ourselves a startup.
Yeah, that's nice to hear. And happy to see like any you have any like notes on 45 Street and so on after the podcast, you can share it with me so that I can see like what you guys are doing there, and I can basically circulate with my colleagues and people and professionals as well, so that they would love to innovate what you guys are doing, and maybe you have some people getting the right job for them.
Yeah, we're in the process of launching the new website. So we're in what we call stealth mode at the moment, but we're coming out of stealth mode probably toward the end of the summer with the new website and stuff like that.
Okay, nice to hear that. And to be honest, like I would just again ask you one further question, which I often get confused at, and it's a global question, which many of students in finance and economics as well are often inundated with, and they are basically too much involved into getting this question, and they are not in a situation to always answer it properly. And I've seen that different people have different answers to it. So it's about 2008 financial crisis as well, that what exactly was the problem and how the real estate became the financial contagion at that point for different parties, because they were I think there were special purpose vehicles made up, there were some other credit you can say books made up, assets made up, and then they were again loaned out to different institutions. So what was the learning from that 2008 financial crisis? And also I've seen that China is also facing a property crisis at present, if you're aware of that.
Right.
So I just wanted to know how does you see it according to your perspective?
So yeah, we'd like to think that the global financial crisis was unique, but if you look at the history of the United States, we've had many financial crises. In fact, they started after the Civil War. They usually happen with a frequency of every 10 years. And the economic conjecture is when a crisis like this happens, everybody becomes acutely aware as to the fragility of financial markets. So, they begin to change their risk modeling. But as you get further away from the last crisis, the emphasis or the emphasis on pricing risk properly begins to fade. People become lax, it can't happen again, and then it happens again. So 08 was an example of that we had gotten far enough away. I mean, people had by that time had completely ignored the dot-com bust, because it didn't have much of a
tangible effect.
I mean, it really affected the value of stock markets, but we didn't see a spike in unemployment, and so people decided that they could imprudently lend money to borrowers who couldn't afford to pay it back.
The subprime loans, yes,
correct. And then when Lehman got into the business, it was really a poor business decision on their part, because they were bankrupt within 9 months.
Yes.
Right. And so the recovery from the global financial crisis was slow, very slow. Right. And then that takes us to the pandemic, which, again, something that most people could not have foreseen. But if you start with the principle that it is impossible to know the future other than to think about it in terms of a Bayesian interpretation, then something like that is now in the data. And we can think about its impact. And in fact, markets tumbled considerably, but they recovered very quickly. And then once it was clear that we would get a vaccine, or vaccines would be available, the markets just recovered quickly, and there didn't seem to be much of an impact. I mean, there was a short run impact, obviously, on employment, but that recovered fairly quickly. Yep. And that's what kind of brings us to today, when the Trump administration first announced its tariff policies, there was a 30% sell-off. And they've recovered now because it's not clear what the administration plans to do. That is its own form of policy uncertainty. But again, in that world, the Bayesian approach to economic modeling makes even more sense, because you can begin to pull in policy uncertainty, which would just have the effect of widening and flattening the bell-shaped curve.
Yes. And actually taking out those possibilities much closer to accurate investing rather than the bell-shaped curve on being on the Six Sigma, you can say. But it's kind of interesting that you guys are doing that. And coming to like some couple of questions, and then we can end up as well. So for example, I wanted to ask, what all intellectual frameworks or analytical tools in your tenure from CBRE or Navigant have remained the most durable in your decision-making approach today as well? And how do you see quantitative models also playing a role in real estate market? Because I know that quantitative models as well as the quality information which we have both play a combined role in giving you a right, you can say, conclusion towards a client. But what do you see that how with the upcoming of the AI and the technology being more advanced, what all quantitative models or tools or analytics things which you have used in CBRE and Navigant are still like more durable in decision making approach today and will be helpful to us as well?
Yeah. So in the 1950s, a famous economist by the name of Harry Markowitz comes up with what we call the capital asset pricing model.
Yes.
Then along come Eugene Fama, Ken French, who improve on that by essentially adding in additional factors, momentum factors that Markowitz did not consider. That, in my mind, is a process of learning.
Yes.
It takes a model to beat a model. And I think that there is certainly on the real estate side, a growing understanding that our industry is not immune to technology or technological change. And we see this on the education side, right? We actually have developed policies around the use of things like ChatGPT. And I say in my syllabus, you may use it or another large language model, but you have to cite it. So if you're going to write a paper and say, pass it through a large language model, you need to cite the model you used. Okay. And for students whose native language is not English, these are powerful editorial tools for them. And I recognize that clearly. I just want them cited. Because I think it's the genie is out of the bottle on this. We're not going to be able to put these things into mothballs. And they too will continue to get more sophisticated. I started using ChatGPT when it first came out. It's so much better now than it was back then. It's much better at answering questions than it was when it first came out. And again, that is process improvement. It's like going from CAPM to Fama French. That took a much longer time period. ChatGPT learns much more rapidly, but I simply think that it can be a valuable tool in the classroom, and I much more valuable, I think, than Excel. It's generative AI can now do Excel spreadsheets, can generate PowerPoints, and as I joke in class, like death and taxes, Excel will always be with us. But there are newer and better tools, and especially this younger generation is much more adept at using them.
Yes. And I think the prompt engineering part, which comes into play here, is also important, because the way you write the prompt is also more important for using a chat GPT. You have to make your own GPTs. You can also make everything accordingly. You can make even client plans in those chat GPT. If you are a good prompt writer and you know how to write a prompt, and you will know that the AI will give you the right answers. Yeah, it's interesting.
But I mean, it would be, again, from my perspective, when I was my students' age, I had a flip phone.
Yes.
Right. And now they all have smartphones. Right. And, I have to tell them, put your phone down. I'm trying to teach you something here, but you can look at it, during the break. So, it's again, just
too much
something that we have to
I get we have to live with it, but too much dependency also is not good, because we need to know these traditional you can say economics or finance rules as well. Otherwise everything will be like on the back of our mind, and then when someone asks us something, we'll just go blank. We'll not able to write even a single line without ChatGPT. So I think the theoretical knowledge should be there. The things which you teach, the things professors teach at NYU, Shack School of Institute, and so on, the Tandon School as well, are quite important, because that knowledge is a knowledge of perspective. Like everything in ChatGPT is factual based, but the perspective you get from an experienced person like your professors is you cannot get anywhere else. So that's the major thing which I think students should go through as well. Yeah, so it's nice. And coming to like for example, a simple question for all the professionals at present as well, to coming to the retail real estate and commercial real estate as well. For example, let's take US market. What do you suggest that what are some points at present a person who is an individual earning like normal average US dollars, what should he focus on first? Should he focus on investing into like real estate, or should he invest like in retail real estate, or should he stay into rent single rent rooms and then invest into commercial real estate as a asset or something? What do you suggest to people? What should they do? Because people are often like in my, you can say like professional, you can say colleagues as well. People are more towards confused as to whether they should invest into mutual funds, stock markets, or real estate.
Right.
And both are taken as different. So, but I believe that real estate is quite a good market to invest into, and it's not taken with that majority as the stock markets or Bitcoin and everything is taken. So what do you suggest that people should do and how early they should start for the same?
Yeah, this is where going back to basic finance, I think, is really helpful. To simply say, real estate, whether it's residential or commercial, has a risk and return structure to it. Right? And you can calculate a Sharpe ratio, and you can compare Sharpe ratios across different asset classes. The riskiest investment is in equity markets, but it tends to have the highest return, not surprisingly. Right? If you ask me to bear risk, you have to compensate me. Real estate looks much more like a bond than it does like an equity, except as we bring in co-working. So with co-working, you can do real-time pricing of space. And that's when real estate starts looking more like an equity than a bond. So the risk and return structure of real estate is attractive to investors because of those two characteristics. Largely looks like a bond, but it can behave more like an equity when there's more co-working, for example, in a building. And as for specific investments, I say this in class too. I'm not a registered investment advisor, so I can't give investment advice.
No, not required as well. I just wanted to have a perspective of how real estate as compared to like other markets or investments should play into the picture as of now. And for like mid-career professionals looking into the real estate and pivot into the real estate analytics and foundational pillars and so on, like what all technical proficiencies you think at in today's world? Because traditional finance, we already know that you should know quantitative models. There will be some aspects or parameters like churn rates and so on. But what are proficiencies in like today's techno savvy and finance we can say world do the mid-career professionals take, and should they learn like Python? Should they learn like some other economic insights? Should they read papers of different like professors like you and get to know more about what exactly the real problems of the world are and how they can be fluent in this?
Yeah, I mean, someone spoke at a conference recently, and this individual said, don't waste your time don't waste your time with Python. I think that statement is wrong for the following reason. One benefit of learning how to code is it disciplines your logic. I mean, coding is just logic. If line 12 breaks, that's like breaking a logical chain. And so I think, I mean, and there's so many free resources out there. So these tools are so easy to use. They're all open sourced. So play around with Python. And I think that's beneficial for mid-career individuals, just from the point of view of logical discipline.
You told me that you like to play tennis. So in today's world, if you want to build a tennis court, what would you keep 3 things in your mind to build it the most spectacular tennis court, like a Wimbledon's one or so on?
So I'm not very good. My father taught me how to play. It was something that I couldn't really do during grad school. And then when I finished up, I went back to the game. I love watching it. And I am trying at the moment to move from a double-handed backhand to a single-handed backhand. And that's a big challenge for me.
Yep. All right. So thank you so much, Timothy. Thanks a lot for coming to our podcast. And I'll share it with you as well. I'll just talk with